Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, I'm just going to do a review about the first lien HELOC, right? So take a look at this. This is my first lien HELOC. $280,000. The lender said, hey, if you take a initial draw of above 10,000, we'll pay your closing costs. And the closing cost is about 1,200. So think about this. You could just put the money in after you withdraw and there's no problem. In fact, I actually asked the lender, like, hey, like, are there any restrictions? Like, is there a certain daily limit that I can withdraw from the account? And they said, no, there's no limit at all. I was like, whoa, that blows my mind because my other HELOC had a $10,000 a month or a day limit for the withdrawals. And now if I have a real estate opportunity or deal, I could, literally with just click of a button, I could get like the down payment or even buy it outright without a loan. Okay, so I got this last Friday, or I finally had access to this last Friday, and now I kind of feel like this, where it's like the infinity gauntlet of lines of credit. Now, here's the thing. I did not replace my mortgage. I paid off my mortgage first, and then I got the first lien HELOC because I've been doing these velocity banking demonstrations for quite a while. And every time I do a comparison of a replacement of a mortgage versus not replacing it with the first lien HELOC, it's kind of like flushing money down the toilet. And I know people are excited about this because they hear things like, oh, line of credit interest good, loan interest bad, but interest in both lines of credit and loans is almost the same thing. Hate to burst your bubble. What we're using the line of credit for is a way to consolidate debt to increase our cash flow, okay, and minimize interest and stop the segregation of income. But if you have, let's say, a mortgage at like 3% and a line of credit interest at like 10 to 15%, simply replacing that mortgage with the line of credit will do most people no good because there's not enough cash flow that you recover from replacing that mortgage. In fact, I really feel like velocity banking is not it's not even related, or it's not paying off your mortgage is kind of the last thing you got to do with velocity banking, but so many people emphasize that because it makes a good headline, right? Even though I paid off my mortgage under 3 years, I paid off the $58,000 in 1 year, right? I did all that. And so I know the benefits of velocity banking, but whenever I see headlines like, hey, just get a first lien HELOC and your mortgage is at 3% and you could get one for 9%, and we're not understanding the ramifications of that, that's why I just got to make these videos. And also, another reason I make this video is because, hey, if you want to flush your money down the toilet, just give it to me, right? Like, you don't need to give it to a lender or the bank, but we'll talk about that. All right, so what is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account. And so what we're going to do is we're going to kind of I already went over this scenario in the last video, but we're going to go over it one more time again, where what the difference between replacing your mortgage versus not replacing your mortgage is. Like, what's the outcome? Would you still do velocity banking? So we only need two things for velocity banking. Number one's a budget, and then number two is a line of credit as your main operating account. So we have a budget here for the average American: income, expenses, savings. Then you list every single debt that you have, and then anything that's not a debt, you could just combine into one line item. Food, gas, insurance, all that other stuff. Okay, you just do that. And then here, you have your income, you have your expenses, okay, and let me just copy them in the velocity banking column. But you don't have any savings, but you got something called cash flow, which looks like savings, right? But the main difference is that whatever income we have, we're going to apply to all of our debt with the help of a line of credit, and we're not going to have any savings afterwards. So you can see right here, $0 beginning, $0 ending, and we applied all of our income to debt. Okay, and then we need a line of credit. So you can see here, this is the line of credit that I showed you with the Thanos infinity gauntlet. That's what it felt like every time I go into the bank's website. It's like, man, I could just make a huge withdrawal. I don't have to scramble for money if I have a real estate deal in front of me. It's pretty sweet, right? So I could even with one snap, one click, I can withdraw $280,000 potentially, right? So, okay, so let me go here. So all a line of credit is a financial tool where you could borrow money, pay it back, and use it over and over again. So some of you might have credit cards, but credit cards are not as flexible as personal or home equity lines of credit, right? So personal home equity lines of credit, I can just go on the bank's website, click a button, and just have money in my checking account. Although there's different nuances and flavors, right? Like I always get surprised with one lender. It's like, oh, I can't even make a withdrawal on a weekend. It's weird. Like, what? I can't make a withdrawal on a weekend? Nope. Only before 9 p.m. Eastern time on a business day. And then another lender, it's like, oh, you can only make $10,000 maximum withdrawals in one day. And then another lender is like, we don't have any restrictions. And I was like, sweet, right? It's kind of like fast food, right? Just because you went to McDonald's doesn't mean that Burger King and Checkers is the same, even though they're all fast food products, right? So all the products that you see from a general point of view are kind of the same, but when you get to the little nuances, they're really different. And then with credit cards, there are just more restrictions. You know, I can't use credit card one to pay credit card two. But with the line of credit, I can use it to pay anything. I can use the line of credit to pay the line of credit's bills. It's insane, right? So let's actually restart this. Okay, so let's assume we have an 8.5% home equity line of credit. It just means that you're putting your home equity as collateral, and anytime you do that, you get better interest rates and more limits, right? So if we're going to replace all of these credit cards and the mortgage, I think when I summed it up, it was $517,000 of debt. So what we're going to do is we're going to assume that we have a $600,000 limit. $600,000 limit and then 517000, meaning that we're just transferring or moving all this debt into the line of credit, including our mortgage, which is why people talk about the first lien HELOCs, because usually they have mortgages, but I think for me, at least in my situation, I got a second lien HELOC, right? I got a second lien HELOC. So with the second lien HELOC, you could still use this as a tool, but the most important thing is that the mortgage would be replaced last. And why would it be replaced last? Because to pay off that mortgage, or in order to get the cash flow of that mortgage, and let's say you pay off this $350,000, you only get $1,400 back. Whereas if I pay this credit card and this credit card, that's $65,000. I get more cash flow from here than I would paying off $350,000. So the mortgage is considered a quote efficient loan, but with efficient loans, there's a trade-off of cash flow versus interest, right? The more cash flow it sucks up, the less interest you pay. The less cash flow something sucks up, the more interest you pay. That's one aspect of why we should pay this off, but we pay it off last, right? There's a like even with this 3%, $350,000, we pay 50% interest about. Okay, so now let's go ahead and do this, and then we're going to put 0, 0, 0, 0, 0, 0, 0, 0, because again, we need a debt transfer into the line of credit, 517,000, and the actual velocity banking strategy is your pay goes into the line of credit, your expenses goes down, comes out of the line of credit, so it's 2,500, and then after every single month, this is how much your debt will be reduced, your cash flow. But this isn't the whole story because it's cash flow before the interest on the line of credit, right? So let's go ahead and calculate that. So it's I2 plus 1, and then it's a G2 plus H2 minus whatever our cash flow is, 6821.45. Okay, so now what we're going to do is take the average daily balance, multiply it by the 0.085 interest rate, and then divide it by 12, okay? And then what you do is you just copy and paste. So you see in the first month you pay about $3,600 of interest, and so you don't really have $6,000 of cash flow. It's like 3,000 something, right? So I mean, it's still good, right? Like it's not like the worst thing in the world, but you know we want to look for an optimal situation, right? We understand the trade-offs, like, and if we pay a little bit more because there's a certain convenience factor to it. Yes, I get that, but we don't want to overpay needlessly. Okay, so let's go ahead and do that. And so now this takes 109 months, right? And let's sum up the interest. So I'm going to go ahead and sum it up with the sum function. And so this is about $221,000 and 109 months. Okay, so let's go ahead and we're going to do that here. So this is going to be 221K and 109 months, right? So $221,000 of interest in 109 months. Okay, so basically we paid off our debt in 109 divided by 12, about 9.08 years. So including our mortgage, which is not bad, right? Like average American can't even pay off a 30-year mortgage in 30 years, but we paid it off in about 9. But in order to pay it off, we had to pay about $221,000 of interest, which I'll be honest, I'm not feeling too good about, right? If this is the most optimal situation, I'll accept it. But if we can do better and faster without really changing that much, again, because this is why debt payoff order is so important, then let's do it that way. Okay. All right. So now let's go ahead and do a comparison. And so instead of a $600,000 line of credit, first lien HELOC, meaning we replace the mortgage, why don't we just get maybe a $200,000 line of credit? $200,000. All right. And so now what we do here, okay, so we have our mortgage that we're still going to pay, okay, and actually let's just kind of do this again. So let's just start from the beginning. So instead of, okay, we see we have a penny of cash flow here, so we got to start moving debts. Instead of moving the entire thing, let's just start off with the credit cards first. They're the highest interest debts. They suck up cash flow, so we're going to recover that cash flow by moving this $167,000 of credit cards into that line of credit. So 167,000. Okay, and then now this is all going to go to 0, right? And so that's going to be 1 penny to $5,345.84, which is pretty good, right? So now let's go ahead and do the calculations. So G2 plus H2 minus this cash flow number, 5345.84. And then what we do is we take the interest. The interest is right here with the average daily balance, right? So you take the average, multiply it by 0.085, and then you divide by 12. Okay? So what we're going to do is copy and paste and see how long it takes us. And so now we're going to, okay, do this, take the sum of that, and we see in 21K of interest that was paid in 36 months. So let's go ahead and copy those results. Okay. So now let's just do this. So for the credit card, it's 21K, 0.5K interest, and then 36 months, right? So now, because we're doing the other debt separately from the mortgage, now we can attack the mortgage, right? And you could do it two ways. You could just do the default way of doing it, which is just putting all your extra cash flow or savings directly into the loan, because this will actually be savings now at this point, right? The $5,345. Now, let's ask ourselves this. Do most people, if they have extra savings, let's say have an extra $2,000 savings, are they going to pay the mortgage and put the extra $2,000 in it? Probably not, right? And that's because the loan is a one-way street, right? And so you can put the entire 5,000 in it, but because the loan is one-way street, you can't ever get that money back. Now, what you can do, okay, is that you can use your line of credit as a backup. Like I'm going to put this entire $4,345.84 into here, and then use your line of credit as a backup. But what we're also trying to prevent is something called the segregation of income, right? So the reason why the average American fails to pay their debt is because their income is segregated. You take a look at this. Oh my goodness, payment 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11, and your paycheck comes in and split into different ways. That becomes a problem for them, and it becomes harder to focus. It's the magic word, to pay off all your debt. Right? And you might say, "Oh, segregation of income. That's not real." Yeah, tell that to the person who emailed me here. Like this person actually had like $4 in cash flow. I need to reset this. It's not 375. It was like $4 savings left over and had 22 debts. right? You look at this and you're like, whoa, this income is totally segregated. And you could understand, in a real life scenario, again, I didn't make this up, $4 left over. Why did that happen? Because we segregated our income. And here, even we're at this stage, we still don't want to segregate our income, right? We want to it's like driving a car and just like saying, hey, I've been driving for 20 years, haven't had an accident, let's just not put the seatbelt. Why don't we just put the seatbelt on even at this point? I don't know why people have like such an issue of still using your line of credit when it achieves the same result, and it gives you the benefits of not segregating your income, paying it off quickly, controlling your cash flow, and putting all your money in one place, making it easy. Easy has a lot of value. You make things too complicated, people are not going to do it, right? This is why like a lot of people say they failed with like Dave Ramsey, because they did all this budgeting and planning. It's just too hard to keep track of all the stuff. Like especially when you do it in real life implementation, but when you just kind of have a very basic plan, it becomes so easy. So one of the things that we can do is, well, let's just move a portion of the line of credit into the mortgage into the line of credit, and really like as a rule of thumb. Okay, well, first of all, you have to make sure that the mortgage is paid last. But number two, just use a amount that's kind of similar to your paycheck, like 10, 15 grand, right? So this is 9 grand. But let's just kind of do this. Let's just do 10 grand, okay? So let me do this, and I'm going to do 10 grand, 10000, right? And I actually probably should highlight this right here, 10 grand, okay? So 10 grand, right? And how long did it take us to pay out that 10 grand? About 2 months. Okay, so if you take a look at the loan calculator right here, and we could just put in a month how long we think it will take us to pay off to 10 grand. So 25, wait, what do we go? 35, so we want 340. So let's just 12, 13, 14, 15. So about 15 months. So it took us 15 months using the way that the bank normally wants to do it, to pay just the monthly payment, which you can also think of as a minimum payment, right? And after 15 months, we paid off 10 grand. Yet when we do it this way, we pay it off in two. So think about if we did this 15 times, how much of debt would be paid off over and over again, right? Now, luckily, we have the Velocity Banking Calculator to kind of figure out like the debt payoff and how much interest we pay and all that. And I think we're at 36. Was it 36 months? Let me just take a quick look right here. Yeah, 36 months. That's when we paid off the credit cards. So this would be the current balance, the amount of interest that we paid, right? And so let's just open up that Velocity Banking Calculator and we'll just fill out the details, right? So give me 1 second to fill that out. And I think I already had it filled out from another demo that I did from the previous video. So whoopsie, let me just take a look right here. Yep, there it is, that Velocity Banking Calculator. Just fill in the details. And got this from Renatus. Again, this is where I originally learned it from. And full disclosure, I actually do make commission off of selling their products. It's kind of like the entry fee required to enter my so-called cult. Wink, wink. Although I'm not a cult leader, just like O.J. Simpson is not he didn't do what he said he did. He just wrote a book about it. Anyways, all right, so we just put in the information: original balance, current balance, interest rate, term 30 years, payment amount 1475, chunk amount. It's just how much are you moving to line of credit, and you'll realize that the amount that you so-called chunk makes absolutely no difference unless you replace the entire mortgage, right? So it's because the number that's really important is this cash flow number right here, and let's go ahead and we'll say we'll just do like $20,000 and take a look here. So 4.3 years and 23,000. It's probably going to increase by a little bit. So how much does it increase by? Oh, about a grand, but the payoff's still the same, right? So again, you don't need a huge chunk amount. The chunk amount is just kind of there to kind of figure out if you did a certain chunk, how much interest and years would you pay. But the lower the chunk generally, the more the less you pay. But although I've kind of found it strange that I've done lower chunk amounts and actually pay more. It's a really bizarre, like, I'm not sure how to explain this. And I kind of, again, I didn't create the calculator, but I'm kind of wondering why in certain amounts that are lower I actually pay more. It's crazy. All right, but let's just go ahead and as a general rule, just do like an amount that's similar to your paycheck. We should be fine. But here's the thing that I don't want you to do. You got a 3% mortgage, and then you replace it in your line of credit. This turns to 5 years, and this turns to 75 grand, right? So what do you want to pay? 75 grand of interest, or do you want to pay 23 grand in interest? No brainer, right? So let me just go back to the other screen right here, and let's switch this right here. So this is gonna take us. I need to calculate the interest. So on the other screen, the interest was 23.1 grand. So 23.1, right? So what's 30 plus 30.5 plus 23.1? That would be 53.6 grand of interest. Okay, and then let me just write that. And how much was the time did it take? 4.3 years. So 43.6 and then 4.3 years. So let's go ahead and copy that. And then we're just going to do that right here. Blah, blah, blah. Okay. So now the mortgage is going to take 53.6K and 4.3 years, right? And so now let's kind of just do a comparison. Okay. So 221, so 109 months divided by 12, that's going to be 9.08 years. 9.08 years. Okay. And so now this one is going to be 7.3 because 36 months is 3. So let's just do this 4.3 plus 36 divided by 12. 7.3 years, right? So now this is 7.3. Hold on. 7.3 years. And how much is the total amount? So 21.5 with the credit card interest plus 53.6. That's going to be 75.1. Okay, K. So let's calculate the difference, right? So what's the difference between the results? So in interest, it's 221 minus 75.1. Okay. So that's $145,000 of interest. And then in terms of years, 9.08 minus 7.3, right? That's going to be about 1.78. So this is time, and then this is interest. And so if you want to flush $145,000 down the toilet, just give it to me because I'm always thinking, like, hey, I don't really need a Tesla, but if you want to give that to me, just do it. But why would you give it to the bank? Don't you like little old me? Probably not. All right, so now let's go ahead and you see 1.78 years is the time that it takes. So again, if someone said, "Hey, it took you longer to pay off the debt, but you paid less interest than this 75.1, maybe like 60 or 50 or 40K," I'd be like, "Yeah, sure, I definitely do that." Right? But it's like we pay more in time and more in interest, and it's like I don't know, I just feel like, the result, what's the result? Flushing 145K down the toilet. And you know what I need? I need one of those like morning zoo radio producers that has like all those sound effects and then flush down the toilet. Man, I really need one of those. So I probably need like an AI assistant bot to help me do that. But yeah, flushing 145,000 down the toilet. So how do you feel now? So this is why I don't promote like first lien HELOCs, especially for those of you who have really low interest rate mortgages, right? I don't know why you do that, but that's why it's important that you do the math. And again, I'm not saying that you do or don't do this because I don't give any professional advice because I'm just a guy on the internet who just does spreadsheets with low effort and somehow make about $300, $400 a month on YouTube just doing these spreadsheets that are low effort. So easy, right? Okay, so now, yeah, that's it for today. So hopefully you have enjoyed this and you could do it yourself because what's the value of doing all this is that you actually do it yourself, right? don't rely on me. And it's so weird how people are like, they want me to do everything for them, and then they put no skin in the game, and then wonder why like I'm not responding to their emails. Okay, well that's it for today. Then have a great day, and we'll speak next time.